Good afternoon, formally, everyone. I'm Dennis Boyer. I'm the president of Nonprofit Net's board, and I'm welcoming you heartily to today's Zoominar, what executive directors and everyone else need to know about basic finance, budgeting, and year-end process. Our Zoominars are open to everyone without charge, but Nonprofit Net incurs costs to bring them to you. So we hope you'll consider supporting us with a suggested donation of $10 or $20, even more if you can. NPN needs your support to keep the Zoominars coming your way. So we're going to send you a link to our donation page through the Zoom chat. And your feedback is so valuable to us. We'd appreciate it if you would respond to the satisfaction survey, and we'll send you a link to that as well. If you are an executive director, here's a special opportunity you won't want to miss. NPN's Leadership Acceleration Program. It's designed to provide executive directors with exposure to perspectives, tools, and ideas that go beyond just the familiar. Highlights include working on a significant project for your organization, peer group meetings, executive coaching, tools and concepts, and periodic assignments. Not enough time to give you a full description now. For more information, just go to our website, nonprofitnet.org, and click on Leadership Acceleration Program. There are just a few slots left, and the formal deadline is tomorrow, but you'll be given a few extra days to submit letters of support, which are part of your application. So nonprofitnet.org, Leadership Acceleration Program. And now on to today's presentation, what executive directors and everyone else need to know about basic finance, budgeting, and year-end process with David Orlinoff, a financial management expert in the nonprofit community with 35 years of experience. Welcome, David.
Thank you. You'll see when I put up my first slide that I've changed the name of the program, but I'll explain that when I get there. I'll introduce myself a little more on that first slide, but let me just say that Dennis and Dora were kind enough to send me in advance questions that had been asked by some of you and some who are either going to join later or haven't joined, are not planning to join. But there were roughly about 20 or 25 questions. And there were several themes that came across in those questions. I would say that in general, the three major themes are the role of governance with respect to finance, budgeting, and just general operational finance kinds of questions. And on my very first slide, which I'll put up in a moment, I am going to say that the answer to almost every question that I would be asked is the same. And that is, it all depends. And what does it depend on? Most of the answers would depend on the size and complexity and culture of your organization. So I can't really answer these kinds of general questions in a way that will fit everybody, but I will try as we go to answer. And logistically, we'll have to work out how is it going to be possible for so many people to get my attention to ask individual questions, which I hope we'll be able to have some time to do at the end. But let me give you two examples of what I mean by it all depends. Some of you may have heard what I would call folklore, which is that every nonprofit should have 6 months of cash in reserve. And the short answer that I would have to that is no, that's not the case. It may be true in some cases, but it's not necessarily true in every case. Several years ago, I was doing a training for a group of women nonprofit leaders, and one of them raised that question. She said, Uh, she said, I've heard that all nonprofits should always have 6 months of cash in reserve. It happened that I knew this person, and I said to her, you are the pastor of a 150-year-old church. Mary Barrera, you may have been at this training that I'm talking about. Anyway, she said, I've heard that every nonprofit should have 6 months of cash. And I said, you're the pastor of a 150-year-old church. How often would you say in the 150-year history of the church that there's been 6 months of cash on hand? And she said, probably never. And I said, okay, so there you have at least one major counterexample to that folklore. It all depends. Social services organizations in Massachusetts that file a uniform financial report were surveyed at the end of 2018. 65% ended their fiscal year with less than 30 days of cash. Okay, that might sound scary to some of you, but it wasn't scary to most of those social service organizations because they knew they had steady income coming in from the state on a twice-a-month basis. So that's one example of why there is no one answer to a question. Another one is related to how you fund your organization. During the period 2000 to 2006 and then 2006 to 2013, my wife was the CEO of two different small nonprofits, relatively the same size, relatively the same staff, relatively the same annual budget, but very different in terms of where they got their money. So in one case, all the money was philanthropic. So my wife's goal was to increase the percentage of major givers and multi-year gifts. In the second one, her focus was on increasing the earned income to sell more of the organization's services rather than rely on philanthropy, which they had been doing for its previous life. So those are things that will depend. Whatever you ask, I'm going to say it's going to depend. Well, anyway, let me get started. So, as I said, I've changed the name of this presentation because I want to focus on things that might keep you awake at night that shouldn't, things that are controllable, or things that if they aren't controllable, you can at least figure out ways of trying to make them controllable. So our agenda will be to talk about 5 keys, and then hopefully as we come to an end, I'll have an opportunity to answer questions. I'll try not to say it all depends every time. And then I have an offer for you at the end of the presentation. So who am I? As Dennis mentioned, I have been in the nonprofit world for a long time. I've actually had more than 40 years of experience as a chief financial officer, and the last 32 years in the nonprofit world. I also teach graduate courses at BU and Tufts in financial management for nonprofits. I've been on many boards. I've been chair of 3 of them. I'm a former board member of Nonprofit Net, as a matter of fact. This is, I think, my 7th time speaking to this group. And I've been a member of the United Way Audit Committee in Boston for over 20 years. And I keep asking about term limits, and they keep laughing at me. So I expect to just stay on that committee for a period of time. And I already answered why I give the same answer to a variety of different questions. And the answer is, it all depends. So I'm going to talk about the 5 keys. And the first one is not a technical financial question. It's, what is your mission? And you might think that's an easy question to answer, but it isn't always. I'll just give you an example, not from the world of nonprofits, but I got my start in business more than 50 years ago, working for a railroad in Los Angeles, where I grew up. And in that period of time, the railroad business was failing. And part of the reason was they lost sight of their mission. They thought their mission was to run good railroads. And in fact, their mission was to get people and freight from one place to another at a reasonable cost. And it took several years of poor performance and consolidation in the industry to bring that mission back. So you need to think about your mission in light of what your stated mission statement is, and then look at, are we really doing that? And here's another question that comes up with respect to your mission. Are you the best people to be doing it? Or is there someone else you should be collaborating with or turning over your programs to? And that's a hard question to face for members of boards. People on boards don't really like to talk about that. The key in understanding your business model is, where does your money come from? So all nonprofits have at least one and up to three major streams of income. Earned income is the income that you get for selling stuff. And in case of nonprofits, stuff includes goods and services. So you might have a hospital that sells medical services. You might have a college that sells educational services, but also sells books, also sells room and board. You might be in a place where you don't charge anything, in which case you don't have any earned income. Contributed income is kind of the lifeblood of many of the organizations that are represented, I'm sure, in this audience. And contributed income, as I'm sure you know, covers things like individual donations, corporate foundations, bequests, in some cases planned giving. One question that was on the list of questions was something about charitable gift annuities. Excuse me, I should have turned off my phone. So that's all in the category of contributed income, but not all contributed income is the same. For example, some of your contributed income is restricted to specific purposes. Some of it is restricted to a particular time period. Some of your grants are immediate current use grants. Some of them are long-term multi-year grants. So all of these contributed income sources have different characteristics, different constraints, and different opportunities. Another key point in your business model: who does the work? Many of you work in small organizations or are on boards of small organizations where volunteers are very heavily represented. Others are completely professionally driven, and others deal with a lot of contracted services. For example, if you are in the elder services business, you may have case managers who work for your organization, but whose job it is to arrange for other agencies to provide the services to the actual clients. So these are things that you have to understand. And when I say you have to understand where the money comes from and how you deliver the services, I don't just mean today. I mean, where is it going? Are you working on the right business model for the future? What are the changes that you have to make? And in order to identify the strategies that you want to or need to put into effect, you have to understand where you are today. What are the constraints you face? Are they based on, is the constraint capacity? You just don't have enough people, or you don't have enough, or you don't have enough funds to do everything that you want to do. And at the same time, you don't want to lose sight of the fact that you have opportunities to take advantage of from time to time. So the whole idea of understanding who pays for your mission relates to what opportunities you have to increase those slices of the pie. If you think about a pie graph, every organization's slices of the pie are going to look different as among earned, contributed, and investment income. It's important for you to understand that. So at your next board meeting or the next time you look at your financial statements, look at the revenue sources through this lens. How much of your revenue is coming from contributed sources? How much of it is coming from earned income? If you're lucky enough to have some investment income, how much of it is related to that? And then think about it in terms of how do we want this overall pie to grow if we do, and if so, which slices of the pie need to get bigger relative to the entire size of the pie. Now, I just mentioned looking at your financial reports. So as a financial officer giving this talk, I might have approached this by putting up some actual samples of financial reports on the screen. And since I only have a total of an hour to do this, and I spend the better part of the first 3 sessions of each semester in my classes talking about financial statements, I decided that wasn't the best approach for today. So I want you to just think about what the reports are telling you, and importantly, what should they be telling you? So let's talk about your income statement. You might think of this as an income statement. If your organization uses QuickBooks, that's what it's going to call it. In the formal accounting sense, driven by generally accepted accounting principles, a term of art from the accounting profession, you would be calling it a statement of activities. Colloquially, we generally refer to it as a profit and loss statement, P&L, although I have to say that there are people in the nonprofit world who object to the term profit. Everybody should object to the term losses, I should say. So your income statement should be telling you not only how much revenue have we gotten to date, and how much have we incurred in expenses, and the difference between those, which is either a profit or, if it's a loss, how much have we paid for the privilege of doing this wonderful work. But that's not enough. It's not enough to just have a report of where you are. You need to understand where you are compared to your plan. And so your budget its primary use here is to be able to give you progress reports against your plan. And unfortunately, many organizations don't optimize the use of their budget as a measurement tool for progress against it. And here's why. When you do your budget for the year, it's easy to then load it into your computer system by dividing everything by 12 and putting 1/12 of each item into your budget for the month of whatever your fiscal year is. And so therefore, when you are comparing your actual performance against your budget, you may lose track of the fact that you're not in a linear business. You may be in a more seasonal business. Most of you have a fiscal year that, well, let's say everybody has a fiscal year. Some fiscal years make more sense than others. For example, if you are in a nonprofit that has a programmatic year that more or less conforms to the school year, then having a June 30th fiscal year end makes a lot of sense. But if you have programs that have that kind of seasonal programming, say in the arts or in education, but your fiscal year ends on December 31st because that's when years end, that doesn't make sense. So take a look at when your year ends. Does it make sense according to what I would call the natural business year? And then make sure that the budget that you're comparing to on an ongoing basis during the year makes sense. Here's what, just a couple of examples, which I'll talk about a little bit more on the next slide. But if you are in the kind of nonprofit that raises money through an annual big ticket fundraising item, like a dinner or an auction, then there's a certain seasonality to your business, and it would be unrealistic to expect that 1/12 of your contributed revenue would be coming in each month. You need to take advantage of knowing when you're going to be raising money. Also, if your fiscal year ends in June, for example, your likeliest high months for receiving individual contributions are December and June. December because it's the end of donors' tax years, June because it's the end of your year and you reach out to your donors and say, hey, help us balance the budget for the year. But if you haven't planned your fundraising receipts properly, it's likely that you'll be drawing inaccurate conclusions by looking at your year-to-date budget versus actual. That's your P&L. I'll talk about that again in a moment. What is your balance sheet telling you? A balance sheet is formally a statement of financial position. Means that it's telling you what your financial condition is at a specific point in time. At the end of your fiscal year, it's 11/59/59 on the last day of your fiscal year, which is also 12:01 a.m. On the first day of your next fiscal year. The ending balance sheet of one year is the beginning one of the next. Most of the items on the balance sheet are not particularly helpful to you, but here are the ones that are. How much cash do you have? Now, remember I said at the beginning that it's not the case that you necessarily need 6 months of cash at all times. On the other hand, having a relatively decent cash reserve is a good thing, and you should have some guidelines in place as to whether you think you have enough at any point in time or not. Accounts receivable and pledges receivable. Not all organizations report their income on what's called the accrual basis of accounting. They just look at cash coming in. But many of you are in organizations that accept pledges for grants to be actually physically paid in a future period of time. You also may have accounts receivable if you deal with municipalities and send an invoice to the city of Boston, for example. It's very likely that it'll take a long time for you to get paid. I have this theory that municipalities staff a position called Department of Payment Prevention. So you have to make sure that your accounts receivable don't build up. I'll tell a little story about that in a moment. You also need to know if you've run up any significant payables on a short-term basis, and do you have debt? Have you borrowed money that you have to pay back either in a lump sum at a future time or on an ongoing basis like a mortgage, or an up and down kind of thing like a line of credit. So let me just say something about receivables for a moment. Several years ago, I worked with an organization that, just to simplify the story a little bit, I won't go into a lot of detail, but the bookkeeper told me that after, this was an organization that had a payroll of about $25,000 every week. And she told me the first day I was in the organization, she said, after the bank, after we pay the payroll tomorrow, we will have $93 in the bank, $93, with another payroll of $25,000 coming up the following week, plus a lot of bills to pay. I went into the executive director and I said, let's look at the accounts receivable aging. Let's see why we're in such a tough cash position. Turned out that for a variety of reasons, some good, some not, they had not been collecting on their accounts receivable for a long time. A lot of phone calls got made. The organization collected a whole lot of cash in the immediately following days. And it's 17 years later, and the organization is still thriving, but it was this close to going out of business in 2005. So don't let your receivables get out of control. With respect to your financial statements, one of the key indicators of problems in your financial management is late financial statements. I've been guilty of this myself. I've been the victim of it. I've been a perpetrator and so on. But if statements keep getting later and later, if they're usually done by, let's say, the 15th of the following month, but all of a sudden it slips to the 20th and maybe the 25th, there are several reasons why that might happen. The most common reason for that is that the complexity of your business has grown and the capacity of your financial team, whatever that team may be, has not. Complexity in financial management in nonprofits can really be highly correlated with the diversification of revenue sources. If you have a program or a mission that you carry out the same way all the time, then keeping track of your different revenues is relatively straightforward. But if you have a variety of small revenue sources, in major donors who want reports on how their money is being used, grants that you have to file reports back to, state or federal or city awards that you have accountabilities back for. The number of accountabilities that you have drives the complexity of your financial management challenge. And as that becomes more complex, it's harder and harder for your existing staff to keep up with it. And when it comes to staffing up in finance, it's really a very simple equation. If you're not ahead of the curve, you are behind the curve. There's no such thing as being exactly in the right place all the time. I said I would come back to the P&L. Our variance is explained. You should have on your P&L 3 columns for year to date. Budget year to date, actual year to date, and the variance between them. And variances we usually think of as being favorable or unfavorable. Favorable meaning with respect to the bottom line, that is more revenue than planned or less expense than planned. So we would call those favorable variances, but you have to be careful because not all favorable variances are actually a good thing in real life. For example, if you have spent less money on salaries year to date than your budget called for, that's only good if you're still able to carry out your goals, your mission, and also if you haven't made up for it by, for example, hiring temporary help or consultants where you have an unfavorable variance in those categories. So you need to understand what the variances are telling you and who you can rely on to give you an explanation. And it's important to understand if the variances are related to timing or volume or change in circumstances. When I was at a major organization back in 2004, we had a budget for the fiscal year that started during 2004, was ending in 2005. And all of a sudden the tsunami hit in Southeast Asia, and we got contributions coming out our ears for humanitarian purposes. Obviously, at that point, our original budget was out the door. We had to adjust to changing circumstances. A lot of organizations faced that in the spring of 2020 when COVID hit. They had to change their mission in many cases, but certainly in most cases, their way of operating, which would have had a dramatic effect on their budget. So you have to remember that the budget should be approved by the board of directors, but it shouldn't be such an unchangeable document that you compare post-tsunami life to pre-tsunami life, to use an extreme example. Dennis asked me as part of preparing for this to talk about year-end process a little bit. So I'm going to tell you something that you may not intuitively think is true, but I can tell you from experience that it is. The auditors are your friend. The auditors are your friend. They are not the enemy. It should not be an adversarial process. You should be able to provide the auditors or reviewer, depending on the level of your organization, whether you need an audit or not. Sometimes you need an audit, even though legally you're not required to, because if you're applying for grants, the foundation may ask for your audited financial statements. But the auditors are there to you, they work for you. One of the things that I really don't like when I come in as an interim chief financial officer in an organization is if one of the people that works for me say, well, I do it this way because the auditors told me I need to do it that way. No, it's the other way around. We should do it because we have business reasons to do it. And then we explain to the auditors what we did, and they will then tell us if we need to do something else to make it auditable. I have had the privilege of working with many different auditing firms in and around Boston. I'd be happy to provide recommendations, particularly for you smaller nonprofits that don't want to deal with some of the big firms. I have some recommendations that I'd be happy to share. I have no vested interest, only great experiences. But what's important here in the year-end process is that your finance team, whatever that may consist of, needs to be prepared at year-end to be able to respond to the auditor's request for, please deliver these schedules for us before the audit begins. By the way, I see that somebody has entered something in the chat. I can't see it while I'm doing this screen sharing, so I'm not going to be able to respond. I'm sorry if you're asking a question.
Excuse
Would you like me to
Dave.
voice the question?
Go ahead.
Does the tsunami or other example you just spoke about mean that the board of directors should be approving a revised budget during the fiscal year?
Well, I'm going to guess that you will be able to guess what I'm about to say. It all depends. It is true that the board of directors needs to approve your annual budget. It may or may not be true that they have to formally vote on a new budget. That would depend on mostly the culture of the organization, how formal they want to be, how severe the changes are, and so on. So the best thing to do in a case like that is to have a conversation between, let's say, the executive director and the board chair. Maybe there's a finance committee or treasurer who needs to be consulted in that. But in the cases that I've seen, the typical response is to say, this is our original budget. This is our new budget because of changed circumstances. And here are the variances related to the new budget. But of course, it also depends on when in the fiscal year this happened. In the case of the tsunami, the event took place in month 3 of the fiscal year. So there was a long time to go before the changes, during which the changes would have a significant impact. But the tsunami took place in December. If the organization's fiscal year had ended on December 31st, there would have been no point in doing anything different with the budget. I hope that's helpful. Okay, your profit and loss statement tells you some things about how you're doing, but that may or may not accurately reflect your cash flow. So I gave an example of the organization that had built up so many receivables that it was running out of cash, even though it was operating at more or less a break-even pace. So you have to be mindful of the timing differences, among other things, the timing differences between when revenue is recognized and when the cash comes in. And I'll give you an extreme example. An organization that I'm familiar with, several years ago, the fundraising director reported to a meeting that the organization had had its best revenue year ever. Okay. And yet, when the audit came around, there was a report of a multi-million-dollar loss. How did that happen? It happened this way. 4 years earlier, a major funder had made a 5-year multi-million-dollar commitment to the organization. The revenue from that was recognized in that year. That's the accounting principles that govern this. So for the next 4 years, cash was coming in, but there was no new revenue. And the fundraising director of this organization, when she talked about revenue, she didn't realize that what she was talking about was cash. The organization had grown dramatically in its early years. Everything was on a cash basis. Do we have money? Do we not have money? But once you start getting multi-year grants, you get revenue on your income statement before you get cash into your bank account. You also can have expenses that work the same way. You may be paying for something now, but you're prepaying the expense. Your insurance expense, for example, most of the time organizations run that expense equally 1/12 per month over the life of the policy, but you generally pay for it all at once. So you have to watch where your cash is going. Your balance sheet can help you understand that. If receivables are growing, that means cash is not coming in as fast. If your payables are growing, it might mean that you're slowing down and paying your bills, either on purpose or because you can't process them efficiently enough. But you also have to look at whether you are investing in what are called fixed assets or property, plant, and equipment. Are you buying vehicles? Are you buying computers? Are you buying furniture? Are you buying a building? Those kinds of things mean that you might be using up cash, particularly if you're not borrowing to pay for those things. So it's not just a matter of whether your income statement is saying you're profitable, but are you bringing in and controlling enough cash to keep your mission flowing? A meaningful cash forecast takes into account seasonality. As I explained before, you may have peaks in your fundraising, December and the last month of your fiscal year. You might have an employee benefit plan that pays out once a year rather than along with each payroll. And speaking of payroll, one of the most common ways of paying employees is every 2 weeks, which means that there are certain months that have more than 2 paydays. A couple times a year, if you pay on Friday, and a couple times a year, there'll be a payroll, let's say on the 1st of the month, the 15th of the month, and the 29th of the month, all right? So that means that if you're forecasting your cash by monthly periods, you may be missing out on the 1 month where payroll is hitting your cash much more heavily. So if you are at a point where you have to keep track of not just what your cash is, but what your cash is likely to be in the near future, then you should be doing your cash flow forecast not on a monthly basis, but in this case on a bi-weekly basis, because you have to come up with cash every 2 weeks and not just every month. That goes back to the example that I gave before about the $93 in the bank. It's crucially important to monitor your cash daily. This is not often enough done. You need to check the bank balance every day to make sure that there are no fraudulent transactions that are going through. At an organization that I worked with, we were deluged with fake checks that were being presented to our bank almost every day, thousands of dollars worth. We were prepared for that because we had a system with our bank that the bank wouldn't pay a check unless we gave them a list of all the valid checks. So these checks that were coming in ostensibly from us were not being cashed by the bank, and there's a whole big story about that, which I don't have time to tell, but that's something that you should be doing on a regular basis. I can't also emphasize enough having a plan for when you do start running low on cash. The best thing to do is have a line of credit lined up with your bank. You know, the saying, the best time to buy a snowblower is in the summer. And so if you have a strong cash position and a strong balance sheet, now is the time to apply for a line of credit. It won't cost you very much, but it'll help you sleep at night, which, as I said, is the key point of my talk today. Okay, as I said, some of the questions that were submitted in advance revolved around the interface of governance and finance. So you probably all know this, but I'm going to remind you that all of you in the audience, with possibly a few exceptions, have a fiduciary responsibility to your organization. And fiduciary comes from the Latin word faithfulness. So you must be loyal to the organization, which means that when you are doing work on behalf of the organization, whether it's running the organization as an executive director or being a board member, your responsibility includes putting the interests of the organization ahead of the interests of you personally or of any other organization that you work with. This is, of course, to avoid a conflict of interest. And you also have the duty of care. If you're a board member, it's your responsibility to attend board meetings, to read the financial statements and other reports, to listen carefully to what goes on at the meeting, and importantly, to ask questions. I'm working with a particular board right now, and I think I've attended 8 board meetings, and there's been one grand total of 1 question asked by the board. They're obviously not doing their job. Remember that the board has a few statutory or best practices kind of responsibilities. One of them is, of course, oversight of the executive director. That means hiring, firing, evaluating, compensation, and so on. You should have a robust system in place for determining the compensation of the executive director, because that's a place where the IRS can put you into trouble. But the board also has ultimate responsibility for responsible stewardship of the community's money. One of the distinguishing features of a nonprofit is that it has no owners. This is in contrast to a for-profit business. So the board is representing not just the organization, but the community as a whole, who provides the funding for the organization to carry out its mission. And also, and this is important, what I'm referring to as alignment of mission and activities. And that means that the board should understand what the programs of the organization do, and are they aligned correctly with the understanding that the board has of the mission. And it does require a board to paying attention to this. A strong governance committee. Many organizations, if not all, have either formally or informally a nominating committee. That's not enough. You should have a governance committee that is not only responsible for nominating new members to the board, but also a continuous improvement program for the process of the board itself. Many organizations do an annual or a biannual survey of board performance. And I've been chair of 3 different boards, and in one of them, I actually had a formal performance review with an outside consultant and the board of directors giving me feedback on my performance as a board chair. And I found it very useful, even the parts, maybe especially the parts that I didn't agree with. Finally, everything is public. There's nothing that you do in the nonprofit world that you can hide, with one exception, which is that your detailed donor list that goes onto the 990 can be withheld from public view. But basically everything else, compensation of the highest paid people, compensation paid to the highest paid outside contractors and consultants. There's the 990 has an extensive questionnaire about conflict of interest and independence of directors and so on. That's all important in the governance of the organization, and everybody should understand what their respective responsibilities are, whether they're senior staff or board members or committee members. Finally, many of you come from organizations where the board does everything or very close to everything. There might be one staff person, maybe a half a staff person. So when I say that the board and senior management have to work in sync, it may be that the board and senior management are the exact same people. Regardless, there has to be an understanding of different responsibilities, even within the same human being from time to time, as to whether you are working in an operational role or an oversight and governance role. One of the symptoms that things are a little out of sync is when there's a budget discussion and one board member or another starts asking a lot of questions about some very small item. This is a common occurrence at small boards of small organizations. And my philosophy on it is, as a chief financial officer, I want to give a board all the information that they need to perform their oversight role, but I never want to give them so much information that they can ask me, why are you spending so much money on pencils? And obviously that's an extreme, but it gets into finding the right boundaries between an operational board and an oversight board, and between a board and staff. Just one more anecdote from that. In my early career in nonprofit, I was working on issuing a tax-exempt bond, and the board had a very, very substantive conversation about it. It was a $24 million item. And at the end of the board meeting, I said to the board chair, I said, you know, that was such a substantive discussion of $24 million. You would have thought it was about 2,400. So be careful about that. When you are, and again, I'm focusing on the budget here because it's a great example of this board and management boundary. It's important to focus the board's attention on the items in the budget that have a significant impact on the overall economics of the organization. Mostly revenue. I have a theory, it's been disputed by some of my colleagues as chief financial officers, but my theory is you cannot save your way to fiscal sustainability. If you don't have a plan to keep your revenue growing and at least keeping up with inflation and keeping up with the salary expectations of the people that work for the organization. If you don't have a sufficient growth in revenue, you will be shrinking. And that's not what we're here for most of the time. So it's important to understand that piece of it. I think it's really important in any size organization to have the right balance between resources and ambitions. There are a lot of executive directors and board chairs, a lot of them are founders when they're board chairs, who are visionaries. And they have what we would call a a tendency toward divergent thinking, which is they are always looking for new ideas, always responding to new ideas. And that's great, but the staff, particularly me as the chief financial officer, I have to make sure that we have the resources. And I don't just mean money, I mean management time. The most limited organization resource is not money in most cases. It's the time and attention that the senior management team can pay to this. And if you think back to things that you've seen in your own organization, I can guarantee that you can identify instances where that has been violated, where there's been too much put on the plate of people who are already having trouble doing 150% of their mission. Ultimately, as senior managers and board members, we are not only in the business of carrying out our mission, but we're in the business of making sure that we minimize and control the risk to being able to put that mission out there in the world. Three major categories of risk: financial, operational, and reputational. Operational risk, probably the most important one, because you can have sometimes the least warning of something that might happen. And so I'm just going to make one pitch for something that I'm sure some of your organizations already do, but not all. And that is to make sure you get an independent review, if possible, of your insurance coverages. If you've been with your neighborhood insurance agency or even a larger one, but you've been with them for a long time, it's very possible that your coverages are out of date, that you've just been rolling things over from one year to the next, not getting good outside counsel about what you don't have and what you do have that you no longer need. And in particular, I want to stress cyber insurance. Cyber insurance. In Massachusetts, your organization is subject to tremendous financial penalties if there's an inadvertent breach of personally identifiable information from your donors, your clients, your volunteers, whatever it might be. Somebody has a database of your donors on their laptop in their car. The laptop gets stolen. You, as the organization, are responsible. So you need insurance to protect against that kind of operational risk, which of course then can lead to financial risk. The major financial risk we have to guard against, I've already talked about, which is running out of money. And reputational risk, this might, if you're a museum, for example, might entail whose name do you put on a wing of your museum, Sackler. But you also need to think about how you get reported in the press. I always explain to my students, nobody ever put an article on the front page of the Boston Globe. This is a great nonprofit doing great work with a great team and staying within its budget. That's not what you see on the front page of the paper. So most likely you don't want to be on the front page of the paper. So you need to think about what are the risks that we could have to our reputation, whether it's based on individuals or a failure of a program or just something completely out of our control, and what would we do about it? So I've gone through my 5 keys. I hope that I've given you some information about these things that will, as I say, help you sleep better at night. I'm going to stop sharing, but I'm going to come back to my last slide after I look at the chat and see if there's anything I can do with any of the points raised in the chat. 57 participants. That's more than I can see on one screen. I have a large screen. I can see 49, but I can't see everybody. I'm sorry. I wish I could, but most of you don't even have your cameras on anyway. Let me see here. How's a cash flow statement developed for nonprofits? Very simple. Forget about the one that shows up in an audited financial statement package that's very complicated and the auditors are going to do for you anyway. Very simple cash flow statement. How much did I start with? What came in? What went out? How much is left? All right. Within the how much came in, you might or might not, depending on the nature of your business model, want to break that out into how much came in from donations, how much came in from contracts, how much came in from tuition, whatever. Try not to have too many categories because it's a pain in the neck to go back to your cash account and disaggregate the activity in it to break it out into two small pieces. On the cash out, how much is going out for accounts payable, how much is going out for payroll, how much is going out for the purchase of new equipment or whatever. It doesn't need to be any more complicated than that because that's what you're going to control it by. And also that makes it possible to do a forecast in the same format. I think a question about depression was probably related to depreciation. Depreciation, it might be depression also. Depreciation is a paper entry related to recognizing the costs of assets that you purchased in time gone by. It doesn't appear on your cash flow statement, but buying the asset in the first place would have appeared on your cash flow statement back at the time that you got it. You should budget for depreciation, but a lot of organizations don't because they put their budget together on a cash basis. If you're small enough, that's fine.
Excuse me, may I just interject here? Because I was the one that brought that up. So in a nonprofit environment, you do take depreciation, you expense it every year. So if you're, I'm guessing, so if that's the case, then you would add it back to your cash flow, correct?
For the cash flow statement in an audited statement, don't do that for your,
No.
don't do that. Don't try to transform your P&L into a cash flow statement. Do your cash flow statement based on the general ledger account of cash and the bank.
Okay,
That's it.
so do nonprofits use depreciation?
They must. That was an accounting principle that went into effect in 1991.
Okay,
Before
so,
that, didn't have to.
So does it get expensed every year?
Gets
or whatever
expensed
period?
every year, every month. Yeah.
Okay.
But so what?
No, I was
Right.
just,
Yeah.
I know how it works.
I don't mean to minimize the question. It's just from a management standpoint, it's not on the top 10 list of things to worry about.
Yeah, I just know it's more significant maybe in the for-profit world.
It is because depreciation is a tax deduction. If anybody tells you that we need to worry about income taxes, ask them if they're talking about unrelated business income, but if it's related to our mission, taxes, let the IRS go pound sand. Do nonprofits ever pay director fees? Yes, but only the very large ones like Blue Cross Blue Shield or Harvard Pilgrim Health or something like that. I did work with a nonprofit, a national nonprofit in Connecticut that paid directors a stipend for coming in from out of town over and above the reimbursing the travel expenses, but that's rare in the nonprofit world. And in fact, most nonprofits have a requirement that members of the board of directors have to give money. When I was the interim CFO of a large cultural organization in Boston, the requirement was to be on the board, you had to give $10,000 every year. And not everybody did, but most did. In fact, most gave significantly more than that. Depreciation by assets, I was thinking non-cash, like property, equipment, and furniture. That's what you recognize the depreciation against, yeah. Okay. Let's see, some new messages. Fiscal year is different from the yearly calendar. You should always do your budget on the basis of a fiscal year. The calendar year is not relevant to you if you have a fiscal year that is not at the end of December. Yes, the AGM CPF grant budget template. No, I disagree. Not to slight anybody here from AGM CPF. I know there are a couple. But a grant budget can get overly complicated if you try to follow a template that looks like a profit and loss statement. A much simpler format. And again, it depends on who you're submitting the grant to. They might have a preferred method that you have to use, in which case use it. But most grants can be applied for in a much simpler format by listing the expenses of the grant and followed by a list of funding sources, including the funder that you're applying to. And while I'm on the topic of grants, don't make mistake number one. Don't forget to include indirect costs, quote, overhead, not a term I like, but don't forget to include that. I'm going to take a risk of going over my time here by explaining why. If you do a thought experiment of an organization that is 100% funded by grants, and it only gets its direct costs reimbursed by those grants, who pays for you, the executive director? Okay. You need to bring in money for the indirect costs of running the organization, like the executive director, the CFO, the head of HR, the audit, the lawyer. Some of those are going to be small in some organizations, but most of them are something greater than zero. And if you don't ask for indirect costs on your grant requests, you won't get it. That's rule number 2.
David,
yes.
This is for those who missed the intro to the session. I'm Dennis Boyer, president of the Nonprofit Net Board and the MC for today's presentation. And I think we have run over a bit. Obviously, we have a lot of questions, and I think maybe what we should do is just have you back again.
Okay, I'm happy to do that. But let me share my slide, my last slide, because
Great.
I have an offer outstanding here. I've written some articles about some of these topics, including one on cash flow, one on the impact of just general five things to keep in mind, and another one about different reporting principles related to how fundraisers report contributed income versus how financial people report. So I'm happy to send you those articles. All you need to do is send me an email. My email address is orlinoff@onecfo.com. That's the numeral 1 and CFO like Chief Financial Officer. But not on this slide. If you do send me your question, and which, by the way, I'm happy to respond to, and some of them had to do with referrals, and I have some answers on that. I don't have any vested interest in any consultants that I would recommend. I just want to let you know that. But also, anybody who sends me an email and I send the articles to, I will be also sending another surprise, which is actually related to the possibility of winning a prize, a unique prize, which I would be happy to give to a random winner of somebody who sends me their email address, sends me an email to ask about this. And Dennis, yes, I'd be happy to come again and start where I left off, because I've been talking very fast and still have only covered 1 to 5% of what it takes me an entire semester to teach. So I'm happy to come back.
Wonderful. Well, thank you for that. You've done 2 hours worth in 1 hour, I think. Very, very content rich. So thank you for that very much, David.
Okay.
And that is our final Zoominar for 2022. You're all going to have January off. So the first one next year is February 14th. Our topic then is going to be, how do you establish a digital presence? Our speaker will be Elsa Roberts of Firefly Partners. So that's Tuesday, February 14th, 2023, from 1 to 2 p.m. Before you leave today, please remember that hundreds of organizations have benefited from our Zoominars, and the way we can keep them open to everyone without charge is with your financial support. So please consider a gift to Nonprofit Net, $10, $20, whatever you can manage. We'll be emailing donation links along with our survey link. Also, that we have had so many questions in the chat. A recording of this will be available through our website shortly. So thank you, happy holidays, and we hope to see you on February 14th.
Thank you, Dennis and Dora and everybody at Nonprofit Net.
Well, thank you, David. It really was terrific. We had, obviously great attendance. People stayed through for the most part, which is always a good indication of